Welcome back to our channel, Traders. In today's video, we're going to dive deep into the world of trading indicators. Whether you're an experienced trader or just starting out, these indicators are a crucial tool in your trading journey. From Rsi Divergence to MACD, EMA, pivot points, and Stochastic Rsi. We'll be covering everything you need to know to take your trading to the next level. We'll be exploring the ins and outs of each indicator, giving you a comprehensive understanding of how they work and how to use them effectively in your trading strategy. We know that trading can be a challenging and sometimes daunting task, but with the right tools and knowledge, you can make informed decisions and increase your chances of success. So, if you're ready to take your trading game to the next level, be sure to hit that like button and subscribe to our channel for more informative content like this. Let's get started. Let's start this video talking about a key concept in technical analysis known as Rsi divergence. We'll be covering both positive and negative divergences and providing examples to help you understand these concepts more clearly. So, let's start with the basics. The Relative Strength Index, or RSI, is a popular technical indicator used by traders to identify overbought and oversold conditions in the market. The RSI measures the strength of a security's price action, typically over a 14-period time frame, and ranges from 0 to 100. A reading of 70 or above is generally considered overbought, while a reading of 30 or below is considered oversold. Now, let's move on to RSI divergence. RSI divergence is a phenomenon that occurs when the RSI indicator and the price of a security move in opposite directions. There are two types of RSI divergence, positive and negative. Positive RSI divergence occurs when the RSI indicator forms a series of higher lows while the price of the security forms a series of lower lows. This indicates that momentum is shifting to the upside and that a bullish reversal may be imminent. Here's an example of positive RSI divergence. On the chart of Apple Inc., as you can see, the price of Apple stock is making lower lows, while the RSI indicator is making higher lows. This indicates that the selling pressure is weakening, and that buyers may soon take control of the market. In this case, the positive RSI divergence signaled a bullish reversal, and the price of Apple stock began to rise shortly thereafter. Now, let's move on to negative RSI divergence. Negative RSI divergence occurs when the RSI indicator forms a series of lower highs, while the price of the security forms a series of higher highs. This indicates that momentum is shifting to the downside, and that a bearish reversal may be imminent. Here's an example of negative RSI divergence. On the chart of Tesla Inc., as you can see, the price of Tesla stock is making higher highs, while the RSI indicator is making lower highs. This indicates that the buying pressure is weakening and that sellers may soon take control of the market. In this case, the negative RSI divergence signaled a bearish reversal, and the price of Tesla stock began to fall shortly thereafter. So, why is RSI divergence important? RSI divergence can help traders identify potential trend reversals in the market, giving them an opportunity to enter or exit trades at a more favorable price. It's important to note, however, that RSI divergence is just one tool in a trader's toolbox and should be used in conjunction with other indicators and analysis techniques. If you want me to make a special video on conjunction, where you take multi-confirmation for best win rates, comment multi-confirmation video and I will make a detailed video. RSI strategy tip that you need to remember is that don't blindly take a position into trade looking at positive and negative divergence. You must look at candlestick, trend lines, support and resistance, and other indicators also for best results. One example is this, where we spotted bearish candle, negative RSI divergence along with Stochastic Rsi. Now you might be wondering which are the best time frames for RSI divergence. I will be showing this in the later part of the class, so stay till end of this class and don't skip any part which will get you confused. Moving on to the next indicator, that is moving average convergence divergence, or MACD. We'll cover what the MACD is, how it's calculated, and most importantly, how to use it to identify trading opportunities. Let's start with the basics. The MACD is a trend-following momentum indicator that measures the difference between two moving averages, typically a 12-period and a 26-period exponential moving average, EMA. The MACD also includes a signal line, which is a 9-period EMA of the MACD line. The MACD histogram is the difference between the MACD line and the signal line, plotted as a histogram now. Let's talk about how to use the MACD to identify trading opportunities. There are a few ways to do this, but we'll cover two of the most common ones: MACD crossovers and divergence. MACD crossovers occur when the MACD line crosses above or below the signal line. A bullish crossover occurs when the MACD line crosses above the signal line, indicating that momentum is shifting to the upside. A bearish crossover occurs when the MACD line crosses below the signal line, indicating that momentum is shifting to the downside. Here's an example of a bullish MACD crossover. On the chart of Microsoft Corporation, as you can see, the MACD line blue crosses above the signal line orange, indicating a shift in momentum from bearish to bullish. This would be a buy signal for traders who follow MACD crossovers. The price of Microsoft stock subsequently rose after the bullish crossover. MACD divergence occurs when the MACD histogram diverges from the price of the security. There are two types of MACD divergence: bullish and bearish. Bullish MACD divergence occurs when the MACD histogram forms a series of higher lows while the price of the security forms a series of lower lows. This indicates that momentum is shifting to the upside and that a bullish reversal may be imminent. Here's an example of bullish MACD divergence. On the chart of Alphabet Inc., as you can see, the price of Alphabet stock is making lower lows, while the MACD histogram is making higher lows. This indicates that the selling pressure is weakening and that buyers may soon take control of the market. In this case, the bullish MACD divergence signaled a bullish reversal, and the price of Alphabet stock began to rise shortly thereafter. Bearish MACD divergence occurs when the MACD histogram forms a series of lower highs while the price of the security forms a series of higher highs. This indicates that momentum is shifting to the downside and that a bearish reversal may be imminent. Here's an example of bearish MACD divergence. On the chart of Amazon.com Inc., as you can see, the price of Amazon stock is making higher highs, while the MACD histogram is making lower highs. This indicates that the buying pressure is weakening and that sellers may soon take control of the market. In this case, the bearish MACD divergence signaled a bearish reversal, and the price of Amazon stock began to fall shortly thereafter. Hope you found this information helpful and informative. Remember, the MACD is just one tool in a trader's toolbox, and it should be used in conjunction with other. One example is this, where we spotted bearish candle, bearish divergence along with resistance zone. Let's move to the next indicator, which is the exponential moving average, or EMA. We'll cover what the EMA is, how it's calculated, and most importantly, how to use it to identify trading opportunities. Let's start with the basics. The EMA is a type of moving average that gives more weight to recent price data, making it more responsive to changes in price than a simple moving average, SMA. The formula for calculating the EMA is. Now, let's talk about how to use the EMA to identify trading opportunities. There are a few ways to do this, but we'll cover two of the most common ones: EMA golden and death cross. A golden cross occurs when the 50-period EMA crosses above the 200-period EMA, indicating a shift in momentum from bearish to bullish. A death cross occurs when the 50-period EMA crosses below the 200-period EMA, indicating a shift in momentum from bullish to bearish. Here's an example of a golden cross on the chart of Apple Inc. The green line represents the 50-period EMA, while the red line represents the 200-period EMA. As you can see, the golden cross occurs when the 50-period EMA crosses above the 200-period EMA, indicating a shift in momentum from bearish to bullish. This would be a buy signal for traders who follow EMA golden crosses. The price of Apple stock subsequently rose after the golden cross. Now if you keep watching, I will be sharing the best time frames, along with best win rate setups for scalping and swing trading. Now we will talk about trading with exponential moving averages. Using three EMAs 5, 8, and 18, we'll cover what these EMAs are, how they're calculated, and most importantly, how to use them to identify trading opportunities. So, let's start with the basics. The 5, 8, and 18 EMAs are all types of moving averages that give more weight to recent price data, making them more responsive to changes in price than a simple moving average SMA. The formula for calculating the EMA is. Now, let's talk about how to use the 5, 8, and 13 EMAs to identify trading opportunities. Here's an example of a bullish EMA crossover on the chart of Tesla Inc. The orange line represents the 5-period EMA, while the blue line represents the 8-period EMA, and the green line represents the 13-period EMA. As you can see, the 5-period EMA crosses above the 8-period EMA and the 13-period EMA, indicating a shift in momentum from bearish to bullish. This would be a buy signal for traders who follow EMA crossovers. The price of Tesla stock subsequently rose after the bullish crossover. If you found this video helpful, please hit the like button and subscribe to our channel for more trading tips and strategies. Now I will share my personal setups while trading with EMAs. Let's start with scalping day trading setup. My EMA trading setup for scalping day trading. The time frames for all indicators discussed in this class will be shown in the end of this video, so for now just focus on these setups. For scalping day trading with 5, 8, and 13 EMA, follow these steps as shown. Step 1. The sequence must be correct, that is for buying setup. 5 EMA should be at top, 8 EMA in middle, and 18 EMA at bottom. Once this setup 1 is completed, look for a bullish candle, which I have shown in class 1. Now you have two confirmations to take this trade. But wait! This can also fail, so we will look for another confirmation that is a trading pattern or a market consolidation. These are the best third confirmation you can take for this EMA scalping day trading setup. This is a bullish trade example in Tesla, where all steps were confirmed. Now let me show you a bearish trade example in Tesla, where all steps were confirmed. Now let's jump into my swing trading setup with EMAs. My swing trading setup with EMAs is simple. We will use golden and death cross setup for best results. First, let me show you my swing trading setup. Note, this setup can sometimes give our targets in same day also. The rule for this setup is simple. We will use golden crossover principles over here, but our entry will be much before the crossover happening. 200 EMA must be at top of 50 EMA for this setup to work. Once you have spotted this is present, you must start tracking this stock or cryptocurrency. But this is not enough to jump into trade. We must look for a chart patterns breakout or a range break with bullish candle. Please remember that the candle we use for confirmation over here is power candle only. No other candle shall be used as confirmation over here. Once you spot bullish closing above 50 EMA, you can take your entry with stop loss below the entry candle. Your profit must be taken once the candle touches or is near to 200 EMA. For sell entry it's vice versa. 200 EMA must be below 50 EMA. Note, here you must get the confirmation of bearish power candle closing below 200 EMA with a chart pattern or range consolidation. Now that you have understood the rules for this setup, there is one thing that you need to always look for before all this confirmation. Always look for the good distance between these two EMAs. The distance must not be very small or very big. Remember, this is a high-risk, good-reward strategy, so always use a stop loss. Now let's see the 3 EMA setup for scalping day trading. The rules for this is same as discussed earlier before. To increase your win rate, you must look for a chart pattern or a rangle consolidation breakout. Moving to next trading indicator, that is pivot point strategy, a popular technical analysis tool used by traders to identify potential support and resistance levels. We'll cover what pivot points are, how they're calculated, and most importantly, how to use them to identify trading opportunities. So, let's start with the basics. Pivot points are a type of support and resistance level that is calculated based on the high, low, and close of the previous trading session. There are several types of pivot points, But the best one is Fibonacci. Fibonacci pivot points are calculated using the Fibonacci sequence to determine the support and resistance levels. The formula for calculating Fibonacci pivot points is as follows. Now, let's talk about how to use pivot points to identify trading opportunities. There are several ways to do this, but we'll cover one of the most common ones, the pivot point breakout strategy. The pivot point breakout strategy involves buying or selling a security when it breaks through a pivot point level. For example, if the price of a stock breaks through the R1 level, it may indicate that the stock is bullish and traders may look to buy. Conversely, if the price breaks through the S1 level, it may indicate that the stock is bearish and traders may look to sell. Here's an example of the pivot point breakout strategy. On the chart of Apple Inc., the green line represents the pivot point, while the orange lines represent the support and resistance levels. As you can see, the price of the stock breaks through the R1 level, indicating a bullish breakout. Traders who follow the pivot point breakout strategy would look to buy at this point. The price of Apple stock subsequently rises after the breakout. But, as I have repeated throughout this class, you must always trade with other confirmations and never forget to place a stop loss. But over here, if you look carefully, LPR candle was spotted at R1 level, and also it took support at previous days closing. Another example is with trend line, where we spotted evening star pattern at R1 and also a trend line was present. I have given all the links below in this video, which will help you start trading from absolutely zero levels. The last indicator is Stochastic Rsi, a technical indicator that combines the stochastic oscillator and the relative strength index, RSI, to identify potential trend reversals. We'll cover what Stochastic Rsi is, how it's calculated, and most importantly, how to use it to identify trading opportunities with different K, D, RSI lengths and stochastic lengths. So, let's start with the basics. Stochastic Rsi is a momentum oscillator that measures the level of the RSI relative to its range over a certain period of time. It is calculated by taking the stochastic oscillator of the RSI values. The indicator oscillates between 0 and 100, with overbought conditions typically above 80 and oversold conditions typically below 20. The formula for calculating Stochastic Rsi is as follows. Now, let's talk about how to use Stochastic Rsi to identify trading opportunities with different K, D, RSI lengths, and stochastic lengths. Stochastic Rsi settings are in front of you. These settings are used by many traders and are a good starting point. In general, a buy signal is generated when the Stochastic Rsi crosses above 20 from below, and a sell signal is generated when it crosses below 80 from above. Here's an example of the default Stochastic Rsi settings. On the chart of the Tesla, the blue line represents the Stochastic Rsi indicator, while the red line represents the price of the Tesla. As you can see, there are several buy and sell signals generated by the indicator. Traders who follow the Stochastic Rsi strategy with default settings would look to buy when the blue line crosses above 20 and sell when it crosses below 80. But wait, if you trade on this basis, you will surely make losses. So to increase our win rate, we must take confirmations of candlesticks, support, and resistance, trend lines, and other indicators. Let me show you an example on how I trade with this indicator for best results. This is an example where I have considered trading Stochastic Rsi with gaps. Over here you can see a bullish candle formed at this gap zone with Stochastic Rsi, giving us a buy signal. Looking at another example here, the gap was broken with a bearish candle at gap area, and at this time we also get a sell signal. Now let's see the best time frames and confirmations for these indicators that you are waiting for. I have linked every video down below that will help you become a profitable trader. If you have enjoyed this video, leave a like, comment, and share it with others.